Okay, let's get started. So thank you all once again for taking time out of your Monday evening to join us for this market outlook session. My name's Amanda, and I'm the country manager for StashAway in Singapore. I am super excited to have two very experienced panelists with us today to share their insights on the year ahead. So we have Freddie, who you guys might all be familiar with. He's the Chief Investment Officer and co-founder of StashAway. We also have Clara, who is from JP Morgan Asset Management. And I think what I'll do now is just get the both of them to quickly introduce themselves for about 30 seconds to a minute. I think they'll be best placed to tell you a little bit about themselves. So maybe Clara, do you want to start off to just quickly introduce yourself to everyone?
Sure. Can everyone hear me okay?
Yes.
Okay, that's great. So very good evening to everyone on the line. My name is Clara Chong, and I am a global market strategist at JP Morgan Asset Management. I'm Singaporean, and actually I just returned from New York after 8-year stint as a multi-asset portfolio manager focusing on tactical and strategic asset allocation. Very happy to be back and very glad to be spending this evening with all of you.
Hi, everyone. I'm Freddie, and as Amanda has introduced, the co-founder StashAway nearly 5 years ago. As you can see, my background, apologies first, and disclaimer, I'm in the wine academy right now, and you may hear background noises because of classes next door, so advance apologies.
Yes, thank you, Freddie. Actually, just quick fun fact for everyone, Freddie's getting his wine certification, hence the background and hence why he's at the Wine Academy as well. So just really quickly, once again, thank you both so much for taking the time to join us. So what we're going to do is we'll start off with a quick 15 minutes presentation by Clara, more of a market outlook presentation to bring you all through JP Morgan's kind of insights on the year ahead. And then Freddie will also take a couple of slides to actually talk about the recent reoptimization that we did, as well as our kind of own house view of the year ahead as well. So if you have any questions, please feel free to post it in the Q&A box that you see at the bottom of the screen. The reason that we split it to a 15-minute presentation from both Freddie and Clara is that we wanted to make sure that we get a good foundation out there, and then also make sure that we leave a good amount of time to answer any questions that you have about markets, as well as about the StashAway reoptimization. All right. So maybe Clara, what I'll do now is I'll go ahead and share the screen for you, and then you can take it away. All right.
Sure. Thank you.
Let me just do that, and then you should be able to see my screen.
Mm-hmm. Yeah,
Okay.
that's great. Okay, so hi everyone again. It's been less than 2 months into the new year, and I know it already feels like a century, with equity market volatility hitting a high of 32, developed market equities down close to 8%, high yield spreads widening by 60 basis points. And at the same time, oil is trading at around $94 a barrel, adding to inflation fears, while the Russia-Ukraine situation remains quite tenuous. And Omicron is still very much at play, contributing to the tightening of restrictions in some parts of the world. And it really feels like there's nothing to cheer about so far in 2022. So in the next 15 minutes or so, I will be presenting our market outlook and outlining some of the reasons why we are still optimistic on risk assets, and hope that it serves as an anchor that you can hold on to as we sail through more challenging waters this year. So economic outlook. So the value of any investment is primarily determined by two things: the volume of economic activity as well as its pricing. Hence, growth and inflation are two key environmental factors that really affect markets. So turning to the next page, please. On the growth outlook. Yeah, this one. Yeah, we continue to believe that the global growth outlook remains relatively robust. So even though the pace of growth has slowed, global PMIs, as you can see on the screen, still remain firmly in expansionary territory. Manufacturing continues to be a very bright spot, while services have some room to catch up as global economies get better and better at navigating successive waves of the COVID-19 variants. On the next page, it's where global inflation trends are more interesting. So while we're seeing multi-year highs in developed markets ex-Japan and in EM Latin America, EM Asia's inflation has actually been much more benign due to a delayed pace of recovery. For one, China's inflation continues to be very manageable, coming in at 0.9% for January, which really supports the case for the government to step up more on both the monetary and fiscal front. But on the next slide, US inflation continues to remain as a top concern for investors, especially given the last time we saw inflation higher than 7.5% was December of 1981. And I'm very sure that many of us on this call weren't even born then, myself included. But looking closer at the decomposition of the headline number on the right-hand side would give us a little more insight into what's driving this very high print. So if you visually add up the gray, the blue, and the green sections of the latest inflation bar in January, you'll see that more than half of the 7.5% number comes from autos, reopening, and energy. So these are the more transitory components of inflation that we believe will move lower as supply chain constraints resolve and energy prices stabilize. Shelter inflation, which is the purple part, is something that we continue to monitor very closely, as there's traditionally been a tighter link between the strength of the labor market and shelter inflation, making it more sticky. But so far, even though it has picked up, we're not really seeing a very significant bleed through from higher wages to core services inflation, which is a very good sign. So on the next page, we explore a little bit more about what's causing this wage pressure that we're seeing in the United States. So on our team, we call it the curious case of the missing workers. So there are currently 10.9 million job openings for just 6.5 million unemployed workers. So as the US economy recovered, this unprecedented excess demand for labor has led to higher wages. But at the same time, the supply side was not helping because the participation rate still remains 1.2% below that of pre-pandemic levels, which is really equivalent to about 2.5 million missing workers. But our belief is that this labor supply scarcity should moderate going into 2022 and for the rest of the year, particularly because federal enhancements have expired, unemployment benefits are no longer getting dished out, and there's also the gradual fading of pandemic distortions that have kept workers at home because they needed to take care of their children, for example. Moving on to Asia inflation, in Asia, it's really very interesting because even in places like Korea and Taiwan, which have been a lot more advanced in terms of their economic recovery in the Asia region, they're also seeing very manageable inflation levels between 2 to 3%. And why is that? So despite the recovery, you can see over here that the wage growth in these countries have been very steady at around 3% in Korea and 1 to 2% in Taiwan. So that's a big contrast to the US, where we're seeing average 12-month median wage growth come in at north of 4%, and the low-wage sectors are seeing even more pressure at around 6% year-over-year growth. So now that we've gone through, on the next slide, please, growth and inflation dynamics, I think this is a great segue for a discussion on monetary policy, which has really been a key driver of markets since the beginning of this year. So on the next page, you'll see that while the DMX Japan central banks started to pivot a little more hawkishly at the beginning of this year, the hawkish cycle had already started since last year, and it was predominantly led by the non-EM Asia central banks. But on the next page, if we focus on the recent actions from developed markets ex-Japan central banks, like the Bank of England and the European Central Bank, for example, their meetings in early February were all more hawkish than expected. For the BOE markets, widely expected a second rate hike, and the 5-4 vote to raise rates by 25 basis points felt really good until the markets dug deeper into it and realized that the 4 dissenting votes were actually to raise policy rates by 50 basis points instead of not raising it by 25. On a similar vein, the ECB meeting itself did not surprise as they did keep policy rates on hold, but when Christine Lagarde spoke at a press conference, she spoke about how the ECB was really getting ready to follow in the footsteps of the Fed. So, we're starting to see this successively higher inflation prints put some pressure on central banks as well. And markets have also, started to price in almost 7 rate hikes from the Fed, as you can see on the right-hand side chart, 8 from the Bank of England and 2 from the ECB by the end of 2022. So what does this all mean? So it is our view that markets are a little aggressive in pricing the Fed's tightening stance, as we do expect inflation to moderate lower starting from middle of 2022. And I think it's important to remember that the Fed is also data dependent. They don't have more information than all of us do. And they also know that monetary policy operates with a lag. So seeing inflation moderate should really help to reduce the urgency for them to be overly aggressive in the second half of this year. Moreover, we also expect economic activity to gradually revert towards trend growth levels by then. On the next slide, so I still wanted to address the volatility experienced in markets since the hawkish central bank pivot at the beginning of this year, because a lot of our clients are particularly concerned about whether risk asset underperformance is actually a feature of rate hiking cycles. So over here, we did an analysis of all the Fed rate hiking cycles back to the 1970s, and it actually suggests otherwise. You can see, in fact, that risk assets tend to deliver positive returns through rate hiking cycles. And there were actually only 3 out of 22 hiking cycles so far where equity returns were significantly negative. And those were associated with very unique macro conditions. One, we had an average headline inflation level of close to 12%, average PMI levels of around 48, which is in contractionary territory, and an average implied hike pace of 300 basis points per quarter, which is super aggressive. So those are not the conditions that we're experiencing today. Neither are those the conditions we expect to experience throughout the rest of 2022. In terms of cross-asset performance, you can see that global equities tend to outperform credit as the Fed has typically hiked into strength. And within equities, international equities tend to outperform US equities, especially up to 12 months after the first rate hike is delivered, because the global growth environment still remains strong. Value tends to outperform growth and cyclicals outperform defensives. Hence, for our clients, we continue to advocate for a globally diversified strategy when it comes to equities, while the most important lesson is to stay invested throughout the next Fed rate hiking cycle. Moving on to asset allocation, please. One more slide. So before delving into asset allocation, I thought it would be useful to first understand how the return drivers for equities have changed as the global economy recovered from a very deep trough back in 2020 and continued to claw its way back up in 2021. You can see on the left-hand side at the very early stages of the recovery in 2020 that the primary driver of returns was the gray bar, which is multiple expansion. However, as the recovery broadened and the global economy returned to growth, earnings growth, which is the green bar, actually dominated overall equity returns while multiples detracted on the right-hand side of the page. And on the next slide, in terms of asset allocation, we believe that we will continue to remain in an environment where growth is strong, but moderating from high levels. And while history doesn't exactly repeat itself, it does rhyme. And looking back to 1999 for periods in history that are similar to today's conditions, you can see over here that the losses stemming from multiple contraction is actually the norm. However, the silver lining is that the growth environment remains strong enough to support earnings, such that it more than offsets the losses from multiple contraction. The positive excess returns versus the 10-year US Treasury also reinforces our preference for equities versus bonds in the current environment. Well, so there's a price for everything. Turning to valuations on the next slide, this slide, you can see that equity valuations are definitely not cheap in the United States, and it looks a lot more reasonable internationally, especially in parts of Asia ex-Japan. And this is so even after the relatively encouraging performance versus developed market equities year to date. So on a year-to-date basis, Asia ex-Japan equities are down about 1%, while developed market world equities are down close to 8%. So with the exception of India and Thailand, you can see on the top of the page that most Asia ex-Japan countries actually trade at price to equity levels that are either close to or below average levels. And lastly, it's important to hit on fundamentals as well. On the next page, we are not expecting the same level of earnings growth that we experienced over the past 2 years as global economies came out of a deep trough. But we are seeing very decent and achievable earnings growth expectations across global equity markets. In fact, it may be a little low for some international equity markets. For example, we believe that as China becomes more accommodative in its policy stance and the laggards of ASEAN continue to reopen, the export-dependent growth that we've seen in 2020 and 2021 will be joined by domestic demand pickup, as well as a recovery in overall services to help this region deliver robust earnings growth in 2022. On the right-hand side, earnings revisions, while slowing, are slowing down from extremely high levels. And for the most part, they still remain firmly in positive territory, except for Japan, which has suffered a little bit of negative revisions recently because of their tightening of restrictions related to Omicron. So before I conclude today's market outlook, I would really like to reiterate that we expect the global growth environment to remain strong and US inflation to moderate sometime in the second half of this year. The Fed is data dependent, and it is our view that they may not have to be as aggressive as inflation slows into the second half of this year. And we continue to prefer equities over credit and bonds in this environment. And within equities, be sure to maintain a globally diversified equity allocation. And that's it from me. I will turn it back to Freddie.
Thank you so much for that, Clara. That was super helpful, I think, in setting a great foundation for helping everyone understand how the Fed has reacted over the past couple of months, as well as JP Morgan's outlook going forward. So maybe, Freddie, I'll hand it over to you to go ahead and share your screen to take us through your slides as well.
Hi everyone. Let me know if you don't see it well. Just let me navigate. Okay. Clara has really covered a lot of the major points, so I'll be very brief. But this is just a graphical depiction of where the economy is heading. And in the case of the US, we've seen that at the bottom left, we used to be in a recession technically around April of 2020 at the height of the COVID bottom, the COVID impact on the real economy. It was since quickly moved all the way to the right-hand side, top right quadrant, where growth remains decent, but inflation momentum has really caught up. So you can see in the top right quadrant, July 2021, and highlighting to the latest data we have, which is the December of last year. So inflation concern is really the primary driver to a lot of asset class movement right now. Now, at a global level, the story is similar in inflation, but the growth is at a much moderated, much lower level than in the US. And sort of similar to what Clara has mentioned earlier, the multiples, the earnings cycle in places outside the US, and particularly in Asia, ex-Japan, they were on the low side, and things may actually turn. I think personally that a lot of it is in the case of especially China, it will be driven by policy reversals. So this is something that we are watching very closely, but this is the global aggregate outside the US, right? Very completely different picture, but these things can turn around on the growth side and it can kick it into still in the same quadrant on the top right, but higher in terms of growth rate. Just to, I figure a picture is worth 1,000 words because there's lots happening in the markets. Just to pin it down, what's happening for our users, the current market correction started on the 3rd of January this year when S&P peaked. Now, as you can see by this asset class movement, anything that benefits from inflation, they outperform. So US energy stocks on the back of supply chain disruptions, oil supply tightness, and even core inflation really is the outperformer this year. Mind you, it's a very volatile asset class. A lot of things can happen and turn it around. And at the moment, the Russia-Ukraine tension really is keeping energy prices and material prices and even energy stocks and miners, those prices very high. And outside of this inflation and energy story, you have central banks, and Clara has covered in detail earlier, where almost anywhere in the global developed world, except for Japan and China, most places are likely to follow the Fed in accelerating their rate hikes. So monetary tightening is here. While it does not really create, in the data in the past, it does not really create, in terms of the averages, negative periods of return. So I think Clara mentioned there's 3 out of 22 experiences where it was negative for a very special reason. PNI was contracting. It's not the case right now. And inflation was at 12. We were not there yet, but we are somewhat getting closer. So in a way, it's interesting because it does tells you that maybe returns is not going to be negative, but perhaps the path of getting there is going to be more rocky. The volatility is to be expected, and hence, as investors like us, real money investors, it's best to keep in mind our long-term financial plans, right? If your NC is time when the weekends review your risk level, right? You may want to adjust it lower, but you got to stay invested in a cycle because the cycle has never really produced sustainably negative period. You need to stay in the game and compound. Do not let the volatility in the market take you out of the path of compounding. I think that's something that Clara has mentioned repeatedly, and I personally share that sentiment in particular. And lastly, China has been a cleansing movement in 2021. Things could actually start to reverse this year. However, mind you, in the case of Meituan, you see recently where they asked food delivery platform to keep prices low. So there's still some form of e-commerce and tech industry reform that's still going to be ongoing, but it's going to be likely more measured than the shock we see last year. And at the same time, the People's Bank of China is easing in consecutive steps. And with the appointment of the top governing body in China this year, the Politburo, this is a year where they will relook and refocus on growth policies 5 years from now. So for me personally, China and Asia ex Japan may just provide that much needed diversification away from the US situation right now. So I hope it turns out that I didn't collude with Clara, but it felt very similar in thinking because it's data driven. So I'll stop here because this is a core picture, and that's all I have to say. And let's open it up to Q&A, Amanda.
Yeah, thank you so much for that, Freddie. I think it was a good summary of also how markets have performed year to date. So just a quick reminder for everyone, if you have any questions for both Clara and Freddie, please feel free to post it in the Q&A box. I do have some prepared questions just in case, just as we wait for the audience to also submit their questions. So I'll open this up both to Clara and Freddie. So I think you both touched on it a little bit quite briefly, but this is something that has been on the news quite a lot recently. So, the Ukraine crisis has actually spooked markets a little bit. I think investors, especially retail investors, are not really sure how to interpret that as well. What is your opinion on this crisis, and how should investors position their portfolios in light of it?
Sure, I can take it first. So I think when it comes to geopolitics, honestly, your guess is as good as mine as to whether the Russia-Ukraine standoff will escalate or not. But as of now, our base case expectation continues to be that there will be a diplomatic solution. But you really never know with a guy like Putin. And then in terms of history, history really doesn't give us a guide as to how markets will react to any particular conflict. There were some cases where there were invasions and the markets went up. And then conversely, like the fall of Baghdad, for example, the market fell by 1%. So I think in general, what this means is that markets generally hate any kind of uncertainty, which is why sentiment has been so weak thus far. But the good news is, as with many geopolitical events that have transpired in the past, markets also have short memories. So these have tended to have pretty short-lived reactions to this kind of issues. But obviously, I think in this case, it's maybe a little more serious because there is a big transmission mechanism to how it impacts energy prices and hence global growth and the consumer. And the impact, I think, could be a little more severe in places like Europe, which is very reliant on Russia for energy. Europe gets a third of its natural gas from Russia, and Russia also supplies about 10% of global oil production. So any shutdown or like threatened shutdowns or sanctions of these supplies would, push prices even higher from today's already elevated levels. So that's definitely the biggest risk that I see from this whole issue.
Well, thanks, Clara. I would take the game theory approach since there's no real exact historical scenario to draw on. Or you got to think we had a situation where inflation is high, and particularly Europe, as mentioned by Clara, is very dependent on Russia for energy supply. Right. So we had a time when the market is more sensitive to this, and hence it's sort of strategically the right time to come out and cry or yell or shout and negotiate with NATO. Right. So this is really about NATO, it's about Europe, and the US being who they are, they're always involved. So this is geopolitical, this is geopolitic chess games at its best. And it won't go away because there'll be a lot of posturing. You can see Putin willing to step back and pretend to be negotiable, but yet the troops won't be drawn, right? So it's a bit of it's going to be a drawn out back and forth. Trump-like, but Putin is a muscular man who's taken more seriously. So you will see a bit of a Trump-like circles with, of course, less Twitter, less tweet storms and stuff like that, but it will generate impact on and off for markets. So this is a time you need to reevaluate the diversification component of your portfolios. Anything that's too concentrated on the high risk and particularly more exposed to equities, you will also tend to have a more rocky ride this year. A more balanced portfolio provide a lot more, balancing act all over the places that makes the journey a little easier. So this is a time to sort of revisit the compatibility of this this higher volatility situation with your own personal tolerances. So I think that's a reality in the market. And the biggest focus for investors is to find a way to not get KO by the market. Do not get KO by the market. Let me repeat myself one more time. Because if you get KO by the market, you stop yourself out. If rebounded, you wouldn't be able to get back in. So you need to have a game plan, right? You need to stick to your long-term plans, stop to your cash flow contributions, but you need to think about your risk level as well. So I'll stop here before I go on for another 2 days. Back to you, Amanda.
Thank you for that, Freddie. And I think that was a very in-depth answer for a lot of our viewers today. We've received also a couple of questions from clients on that, so I think that was helpful for everyone. So we have quite a few questions coming in already from the audience, so I think let's kind of jump right into it. The first one we have is, what do you both think is the risk of stagflation? So I know we've not seen that for quite some time, or anytime recently, but what do you guys think about that, and how will this affect markets? Clara, do you want to go ahead and start first?
Sure. So just to give the answer from the outset, I think the risks are very low. Just because the definition of a stagflation is that you have inflation without growth. And that is really not the case that we're seeing right now. So like the first slide that I had showed in my presentation, global PMIs, which is a leading indicator of growth, are still in very healthy territory. And this is so not just in one part of the world, but it's across the globe. And in terms of the split of the growth, manufacturing continues to remain very strong. And for services, I think, the risk is more to the upside, that it will, there's more room for improvement versus the downside, just because, a lot of economies like in ASEAN, for example, have really locked themselves up, last year and the year before, as we had successive waves of variants. And now we're starting to see them, adjust a little better to not have a COVID zero policy, but try to really live with COVID as it progresses to a more endemic state. So, in short, I really don't think that stagflation is a base case scenario that we will be seeing as global growth still remains relatively strong.
By the numbers, similar view, and there's still a lot of capital expenditure investing for the future, and in particularly a lot of disruptive technologies that's still yet to change the world. They're just getting started. So in a way, as a human society, as a world, we are still progressing very innovatively, right? And the truth is that what we're confronting is not a direction where markets are or where economies are, but more about the volatility of things, how we get there. So this year, volatility could come back and forth to sort of surprise those who's not well planned, right? So for me, I think a similar view that rate hikes were never really going to create a bear market. They're meant to fine tune the economy. So we take the Fed out of this. Energy, if you treat it as a game theory, what does Russia want out of this? Is manageable. Maybe earnings multiple was low and moderate a little bit because last year was just too strong. But there's still a lot of innovations and growth as a human world. So I'm looking forward many years from here. That path tells me you got to stay invested, find any ways to stay invested.
Yeah. And I mean, just to add on to that, the US consumer is a really big part of the economy. It's about 75% of GDP. And what we're really seeing at the moment is that consumer demand still remains extremely strong. So the recent January retail sales numbers crushed expectations. It rose by 3.8% month over month. And remember that, this is the case even as Omicron hit, and even places like New York had restaurants shut down, but they still found a way to spend, which is really encouraging. And if we look at early signals from Chase card spending data, it also indicates that consumer spending continued to expand in the first few weeks of February, despite the very cold winter, as well as the effects from Omicron. And the most encouraging part is that they are spending in COVID-sensitive categories. So things they have not spent in before over the past 2 years, like airlines, like lodging away from home, and spending more on restaurants as they have started to open up. So yeah, definitely not a stagflation kind of environment that we're seeing.
Thank you both so much. So the next question that we have is relating to kind of so I'm just kind of mixing a couple of questions. We're seeing very similar questions on this right now, which is what are the top sectors that you see kind of investors switching to in 2022, assuming that significantly higher interest rates going forward?
Freddie, you want me to take it?
Yeah, all right, go ahead.
I'll take it first because
okay.
I got a feeling Clara has a longer list than mine. I would say that from our machines and our signals that we received, certainly Asia ex Japan is relatively undervalued, and particularly China because of last year's regulatory headwinds. So that is sort of an opportunity for the patient and for the long-term strategic investors, for real money investors rather than hedge funds or leverage buyers or people on margin. So as a real investors, these are stuff that create future return, right? So we are still very strategically attracted to the region, and in particular in China being one of the countries that leads the fourth industrial revolution of the world on a very grand scale, and how they apply it throughout the economy, how they want to reform. So in a way, we are actually looking at many interesting sectors in the region, and hopefully when opportunities present, we will even broaden further within China, within Asia, ex-Japan in particular. So I'll stop here because I got a feeling Clara's list will be a lot longer than mine.
Oh, it's actually about the same. But no, thank you so much for covering the part on international versus US equities for me. Because, at JP Morgan, we also have a pretty positive view on China and Asia ex-Japan. And, if you can refer back to my presentation earlier on the rate hiking cycle, typically the number one takeaway there is that international equities tend to do a lot better than US equities going through a rate hiking cycle. So that's one. And then the other thing to point out is also, in terms of value versus growth and cyclicals versus defensives. So because the growth environment still remains strong, which is the base case Fed rate hiking assumption. So cyclicals tend to still outperform defensives. It's not the time to go like severely overweight things like consumer staples or utilities, which are more like bond proxies. In terms of value versus growth, even though we've seen longer term outperformance of value versus growth, I think investors have to be, take an active approach when you're looking at something like value. So there's something really interesting that's going on with this factor. If you want to invest in it, make sure that you're doing it versus via active manager, or you're doing a sector neutral version. Because typically what we see going into a Fed rate hiking cycle is that, growth was very strong, the economy is doing great, right? And then what are the things that get cheap? It's things like healthcare, like the defensive stuff. So going into the cycle, you tend to see a big chunk of the value factor, if it's not sector neutral, in healthcare. So if you look at MSCI USA value today, 20% of it is actually healthcare. So, as you go into this rate hiking cycle, this defensive stuff is great. Like healthcare is a great sector, but it tends to, hold back the performance of the factor a little bit. So that's something to bear in mind when you're looking at value versus growth. But things like financials, for example, which is also a big part of the value factor and also a big part of cyclicals, that is one of our high conviction sector bets, just because I think everybody knows this. Like when rates increase, it's better for banks because their net interest margins expand, and it's better for the bottom line. So yeah, bottom line is be careful when you're investing in the value factor. Make sure it's sector neutral, or you're using an active manager, and definitely cyclicals over defensive still at this stage of the cycle.
Thank you so much.
Sorry, Clara inspired me a little bit. So I just want to say that if you look at the economic cycles, the risk of maybe a slight slowing from a high place is in the US. And so quality factor, dividends, lower volatility factors are better ways to position in the US. Even ESG itself has got some pretty similar characteristics increasingly to quality. However, the opposite is happening in Asia, ex-Japan, and in China, and that's where you want to pick up value and maybe even sized factor, which is like small versus large cap. So there are places where you can be a bit more aggressive, more proactive, but there are places where you probably want to tune back that a little bit. So the geography is really a key thing this year, in my opinion.
Yeah, definitely. Because in Asia ex-Japan, actually, if you look at the composition of the index, more than about 50% of it is all of these cyclical sectors, right? Think financials, materials, energy, they remain cheap still. And if you think about the growth trajectory of the economic cycle within Asia, it hasn't really had the cyclical rebound that we've seen in the developed world, right? So when they're going into this cyclical rebound, I think it's best to be invested in these cyclical sectors. And it's great that the Asia ex-Japan index actually has this tilt inherently built into it already.
Thank you both so much. So I think that's super helpful for everyone that's thinking about, how to position your portfolios going forward. And let's shift gears a little bit. And this question is for you, Freddie. So I think you touched a little bit on, actually both of you touched a little bit on China. And this question relates more so to kind of our Chinese tech exposure. And just trying to understand right now kind of our views on it, if we've switched out of K-Web, and kind of just our views on Chinese tech going forward.
Well, we still have it, and first of all, our user and ourselves, we did have a volatile ride because of the cleansing that's going on in China, but these are very attractive factors when you think of from the perspective of very long-term investors, right? So in a way, from what we do as real money investors, we think forward very, very far ahead. And this has a very, very, very good opportunities to start building the portfolio around with, because something that nobody wants in the room today, and if you pick it up, that's on a very, very, very cheap level, that juiced up your return in the future, not because of trend, but because of mean reversion, right? And policies are also turning as well. So you got to focus on the facts, not hearsay. And we remain very, very constructive on how the Chinese internet giants, tech firms can pivot towards other areas more strategically aligned with the Chinese government. These are kingmakers in the ecosystems. They're not just selling shoes online, okay? These are people who can build. Look at Tencent. They built up a huge enterprise solutions platform that the Western media did not even cover. And they were surprised at the end of last year that, wow, It just happened. So these are very, very agile, very, very resilient companies that can choose to realign themselves strategically with China's long-term initiatives. So it's from that angle, we decided to take a long-term view. So we stay on course.
Thank you so much, Freddie. All right, the next question that we have is relating to the, a little bit of the supply chain disruptions, as you mentioned, has caused energy stocks to actually perform quite well year to date. So the question that we have is, what is a good tactical or strategic approach given a broad-based commodity bull currently? Clara, do you want to take that first?
Sorry, could you repeat the question?
So the question was, what is a good tactical or strategic approach given a broad-based commodity bull currently?
Okay, so, well, I mean, I can speak to what our thoughts are on the supply chain issues easing. And, what we really look at is this measure of economic balance, right? And I think there are some forward-looking indicators that investors can kind of focus on to see if there are early signs that these supply chain issues are actually easing. So one thing that I like to look at is the input prices component within the PMI, because it is a leading indicator of headline inflation. We've done a lot of research and testing on this, and what we've found is that this input price gauge, it actually leads headline inflation by about 6 to 10 months, and the strongest positive correlation is at the 10th month mark. And what we actually saw was over the past 3 months, there were 3 consecutive months of drop in this particular input price gauge, which gives us confidence that the headline inflation level is also going to possibly moderate sometime into the second half of this year. And then in terms of how to position yourself from a commodity perspective, I think let's not think about this as like a tactical approach, right? So let's think about what is the biggest surprise from a risk perspective that can happen in terms of everything that's priced into markets today. I really think is the surprise to inflation on the upside. Well, that's not like our base case, but if that were to really materialize, let's look at what are the things that can outperform. And one of the trusted and tested asset classes that have consistently done well during periods of high inflation is commodities, right? So if you want to position yourself for this upside surprise in inflation that is not the base case, then considering adding some form of a commodity allocation, be it through energy stocks or directly into oil ETF, like that could be some ways that you can kind of position yourself for this surprise.
Well, I have somewhat an extended from what Clara said, maybe a fine tuning to view it as a portfolio level. So in normal times when inflation is not a problem, we think about growth versus say government bonds. But in this case, if you think inflation momentum is still going to persist rather than sort of slow down, and you want to play that, you are sort of betting that growth is going to come from, say, energies, materials, and all. But these are very volatile asset classes. They can flip and flop because of events, right? Russia, Ukraine is one. And already there are signs that the PPI, the producer price index, the gap of that versus core inflation has for the last 3 consecutive months starting to slow. So, but if you do not believe that, the more you need to include some protective assets, such as inflation-linked government bonds, especially in the US, because they're currently giving you very good fixed income coupon, because CPI is what, 7+% now. That's a very, very high yield. And if the CPI stays flat and global markets crashes, it becomes more bond-like, right? Because assuming the CPI component don't change, the inflation-linked bond is still a government bond. So you can mix in a certain portion of inflation-linked bonds and certain commodity exposures that Clara has mentioned to create a risk profile that suits your purposes, suits your own tolerances. Yeah.
Thank you so much for that. Okay, so the next question also is kind of your expectation on what would happen once the Fed hikes its rates. Do you expect a pullback in the stock market from that? Yeah.
Let me go first again. I think I got some momentum. More psychologically, if people in a room think about a market as a room, let's say there's 100 people. If there's only one person saying inflation is going to rise, this person is going to be wrong. You're going to lose money in the markets. When there's 10 or 20 people saying it, you probably want to join them because it's still early and there's enough people in the room to spread it around. Now everybody in the room has spoken about inflation and rate hikes. By the rumor, sell the fact, right? The moment when they actually hiked, in line with market expectation that they have guided and communicated, either no reaction or the market actually bounced the other way up. So think about it as a game theory, as a forward-looking voting machine. The market is a forward-looking voting engine, right? So the good news is we are talking about it now. There's so many people in the market. The market expectation is now pricing 5.3 times of a 25 basis point rate hike. Maybe the Fed is going to do 0.5% in the first hike. Maybe we need to price into 6 times 25. Who knows? But we are pricing a lot of of rate hikes already. That's the good news. And we are still here. The market hasn't crashed. So this is the good news. This is the opportunity. Game theory.
Yeah, no, I think I thought that was a really good response. So, for everything in markets, you have to look at what's being discounted. That's really, really key because, if it's something that everyone already knows about, is not going to move the markets. And, like what Freddie said, actually, like as of today's pricing, it's their markets are pricing in 7 rate hikes. And I know a lot of you are watching the news and you're seeing even like JP Morgan Investment Bank increasing like their rate hike targets to 7 for the rest of the year. But like from an asset management point of view, this is really not our base case because we do expect inflation to moderate going into the second half of next year. And the Fed is not trying to kill the economic recovery. They are trying to land the plane without crashing. So what they're really trying to do is to continue to support the economic recovery, but get the level of interest rates to a place that is more appropriate for an economy that has a 4% unemployment rate and labor markets that are relatively tight. So, to Freddie's point, I don't think that the markets are going to crash when the Fed hikes, even if they go at a 50 basis points level, because that's largely in expectations. If you look at the Fed speak recently, you have to distinguish the noise in the market, right? Bullard, he is a well-known hawk. He's always been like that, right? He loves to talk about the most hawkish end of the policy spectrum. But if you look at the FOMC core, which is Powell, Lael Brainerd, who is going to be the vice chair, and John Williams, who is the New York Fed president, these three are the core. And if you take a look at what they're saying, they don't see the need to be extremely aggressive about going at the beginning because, they look at the inflation numbers and they see that most of it is still coming from core goods, right? Which is in the slides that I showed you guys earlier too. It's not really in the sticky part that has more cause for concern, and the Fed has to, really like try to put out the fire. So I think, risk assets should still do relatively well in terms of like equities and credit, and we would still advocate for a globally diversified equity allocation over credit and government bonds.
Thank you so much for that. Okay, and we have a question here from Connor who is asking, we do see tech stocks getting hammered lately due to the rise of higher interest rates. Firstly, do the both of you see investors still valuing tech stocks as stocks that will provide a long-term growth to investors, particularly those tech stocks, I guess, based in the Asian markets?
So I can take that. So I think you're probably referring to the Chinese tech stocks, right? I think generally investors, they need to learn how to adapt when they invest in China, in line with the evolution of the Chinese government's priority. So you have to learn to lean into where the Chinese policymakers want capital to be allocated in the new China, right? And it's not like, whatever they did to the tech sector last year is an effort to destroy whatever that has been built up in technology. There's still areas of focus in software, in industrial automation, and in, low to middle end semiconductors that, align with one of their 5 pillars, right, which is self-sufficiency. So with all of the supply chain constraints that has gone on over the past 2 years, China also recognizes the need to, at least ramp up, their self-sufficiency in terms of producing low to middle end semiconductors, where the tech barrier entry barriers are still low, but the self-sufficiency rate still has some opportunity for improvement. And then if you think about, what companies like JP Morgan are going through as well, like in terms of digitalization and digitization of our businesses, there's still an incredible opportunity there. And think about all the data that we're dealing with. There's still an incredible amount of demand for, migration to the cloud, for example. So I think there's a lot of secular growth themes in tech that still warrants investors to have an allocation to this space in their portfolios.
I think Clara just said everything I wanted to say. There's not much for me to say, but I would just say I'm very happy. I'm a very happy dollar cost averager since July last year, just so you know. In particular, when China, the noise was the biggest, I did a lot of it in July on to the very end of last year. And right now, the other markets are falling too, giving me an opportunity to average in the more attractive entry points for my portfolios. So overall, you stay with your financial plans, stay with your long-term goals. You already have consulted your financial advisors, or you have already chosen a certain risk level with our platform. That shouldn't really change because of some rate hike in 2022. You have a 15-year plan. You have excess money that you don't need to invest for the long haul. Why are we sweating? So when there are noises, there are opportunities.
All right, thank you both so much. So I'm just aware of time now, we're hitting the hour mark. So I think I have one kind of question for the both of you that I think will be a good last question for everyone to just take away from this session, which is, what is one key takeaway or one advice you would like everyone to keep in mind as they're looking to navigate markets this year? As you know, it's been, quite a volatile first quarter. So, any kind of key takeaways you just want them to keep in mind going forward?
I think I'm going to go first because Freddie's probably going to say the same thing because he's repeated this, I think, at least 100 times over the course of this hour. And I have as well at the beginning of my presentation. I think it's really to stay invested, right? Because you're never, I think I came across this quote that was really, really inspiring to me as well as an asset manager. I think it's time and not timing that matters when it comes to long-term investing. So it is really, really important for you to have skin in the game because, if you get out because of the volatility, because you're scared, and I know it never feels great to be part of a volatile environment, but, the most important thing is, to have steady hands, have conviction in the themes that you're investing in, and, average down when the good quality stuff actually sells off. So that would be my advice to all of you, to stay invested.
I just got front run by Clara. She didn't say one thing. She said like 3 or 4 philosophies in there, sneaking a few, right, in a short time. So I'm done for. So all I'm going to say is, I'm going to quote you my favorite person, who is not an investor, but a physicist, Albert Einstein, has famously said, the power of compounding, those who understands it earns it, those who doesn't pays it. And what does it mean? I know he's referring to the expanding universe, but in investing, it means if you pay too much fees, you accumulate it over the long haul. But it also means that if you get taken out by volatility, you don't compound. Where the power of compounding is only unleashed with time in the market, not timing the market. So you got to think about how to stay in, how you do not get KO by the market. That is the number one question for all of us this year.
Thank you both so much for this very insightful session. I think I speak on behalf of everyone tonight. I think it's been very, very helpful for all of us as we look ahead for this year. So to the audience members as well, thank you so much for taking time out of your Monday evening to join us. We do hope that you will join us for future sessions as well. And thank you once again, Clara and Freddie, for your time this evening, and have a great rest of your evening ahead, everyone. Thank you.
Thanks, everyone. Thanks for
Ciao.
having me. Bye.
Bye.